Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
Financial Survival Network is presented to you by Regal Assets. Buy and sell physical gold and silver through your existing retirement plan, 100% tax-free with Regal Assets. If you want to include physical gold or silver in your existing IRA or old 401k, request your free investment kit, which was recently featured in the Forbes and Smart Money Wall Street Journal magazines. Call toll-free 855-678-6620, 855-678-6620, or visit regalassets.com. Is QE3 the straw that broke the Fed's back? Is there anything that can stop the race to debase? Well, Peter Grandich thinks not, but let's hear him say it. Peter, welcome back to FinancialSurvivalNetwork.com.
Well, thank you always for having me on as your guest.
It's always a pleasure. You know that because you've got two things going here. You've got the experience in the market, and you've got a bit of a spiritual attitude towards it that really is kind of lacking in this area.
Well, thank you. Sometimes I wonder if the spiritual is actually a plus or a minus, but it is something. And your leadoff is correct. It is a race at the base now. If you think about what is taking place, not only is it unprecedented what Bernanke has done, but it comes at a time where its main competitors are doing the same thing. Europe, now Japan. I'm certain China, which is already in easy mood, will be pressured to even become more easing. And it truly is a race to the base. And you and I spoke just before we started recording this, and that was the two things that were certain here, in my view, was gold was a slam dunk winner if you didn't think so before, and the U.S. dollar is a slam dunk loser.
Yeah, that's for sure. And with it, we're probably going to see some of these beleaguered miners start heading up, which we have in the past few weeks. We've seen about a 20-something% increase in the miners index.
Yeah, and I think the further you go up the food chain, the better that return will be. While the junior market, I think, will continue to rise because the metals on average will rise, they have somewhat more of a drag on them than the majors will. Towards year end, after we get to next year, that could pan out and kind of be more equal. I think also, and again, never one, I don't think, to take credit in these types of interviews, but I'm very happy internally for my own self and for what I've stated, that unlike many in the hard asset crowd that have been, well, there wasn't that many bulls that long ago on the gold, but I've also not gone the route of at the same time being very aggressively negative on stocks and bonds in the U.S. In fact, I've spoken for months now about kind of like what's playing out and kind of about a Dow going to a marginally new high. And I think what we're going to get now, almost getting into October, is going to be a race to match, I call it. And the vast majority of money managers and people have to understand that somewhere between 80 and 95% of the money that's in the financial markets now is managed money. It's not really individuals controlling their own destiny, but turning it over to so-called professional managers. So many of them's benchmark is up against an index or a yearly performance, and most are behind those indexes. So there's a kind of sense since the move by Bernanke that this is kind of like free money. You know, with up to $85 billion printing a month, it's going to be very hard for stocks and bonds not to go up. And so I think it's going to add to the fuel of chasing the market and lead us towards a rally that I think eventually allows us to eke out, not much above, but at least something above the old 2007 highs. And then as we get into next year, the reality of this and this being the straw that actually broke the camel's back will take hold.
Yeah, so it feels good in the short term, but in the long term, it's really damaging and it's really injurious to the entire financial system.
Yeah, it's kind of funny. I was visioning, and my dad has been passed since 1988, but I remember he used to like to go to Caesars down in Atlantic City, and there was this very long escalator that almost went down 3 floors, and as you went down, you would see more and more of the gambling floor. And I envisioned the Bernanke move as, we like to call him Helicopter Ben, but I guess I called him Escalator Ben, and he just threw out this awesome amount of money all over the casino floor, really all sorts of money to people that they could use. And my view was that almost all of them would not suddenly put that money in their pocket, run out of the casino, and put the money under the mattress. They would just simply gamble that much more. And that's what I think we're going to see in the financial arena, that despite this creation, and really that's why QE1 and 2 failed, is that this money is not going to really move the economy in terms of create jobs and all. It's just going to give the financial arena that much more money to play with, and that money will be used to play with. So financial assets may increase, but the supposed real benefit of this, of truly improving the economy and the common man out there, I think is going to see little or no effect. That's why there's a number 3 at the QE, because 1 and 2, which were supposed to also do this, failed to do the job.
Yeah, and that brings us to something interesting. If QE1 failed and QE2 failed, what are they thinking? How could they possibly think that QE3 is going to succeed? Do they really believe this, Peter?
Well, it takes me back, and again, coming from a little bit of a gambling background, always being a speculator, owning horses, what have you, I have a little gambling and been around gamblers. It's really a gambler's mentality. A gambler, no matter what type of game they're playing or what have you, as they start to get behind, the real smart thing is to cut your bets back until things start to turn, but the tendency is to overbet. Well, that's what I think Bernanke has done. He has concluded that despite his best efforts and what he thought was best with 1 and 2, it didn't achieve it, and he's kind of, whether self-appointed or feeling being the only person that can act, he feels he has to go beyond the call of duty and do whatever he can in his position, even though the real problem has never been a monetarily one. It's been a fiscal management, which falls at the feet of people in Congress and the executive and the White House. But he has taken upon himself, I guess in part because he feels he's not getting cooperation on the other end, because he keeps bringing that up in his testimonies, but he's also gone beyond anything imaginable. And while short-term, just as those gamblers on the floor of the casino will be elated with all this money coming into their arms, the inevitable happens. They will eventually lose part or all of that, and we will wake up one day, probably somewhere in the first or second quarter of next year, come to that conclusion, and that's when the financial markets will take a serious turn down. But until that time, with one caveat, and that caveat is the inevitable conflict that's coming in the Middle East and how big it gets and how that could possibly change the picture. Without that happening, it looks like stocks and bonds can pretty well work their way higher in terms of price through at least the first quarter of next year and possibly the second, and actually eke out new highs in the Dow and even maybe a new 10-year Treasury bond yield low for the U.S. Treasuries.
Yeah, and has nothing to do with the fundamental economy, the real economy, the economy that the average that you produce, that you, the average person, the average American who goes to work, who still has a job, what you produce. The stock market has zero to do with that now, right?
Well, see, that's the other problem. The stock market is almost no longer what it once was. You see, many people forgot, but really what the stock market is a place where people are supposed to have the opportunity to buy and sell upon ownerships of businesses. And you would obviously want to buy shares in those businesses if you think the businesses were going to be worth more down the road. That is not what most of the money is in there for now. It has become a very large casino-like atmosphere. And many of the things that were rules and ways and things how you would approach equities, at one time in my career back in the days when I worked on Wall Street, I was somewhat involved in quantitative analysis. And I think you can throw mostly all types of analysis out and almost get a big spinning wheel and put numbers on it and spin it. And that's kind of the atmosphere now that exists. And this is all during a period of time when we already know how shocks have been created because the spinners are out of control, and the people who are in charge of regulating them and so forth can no longer do it or no longer care to the point of preventing the next disaster. And that's the other fear that's out there. I don't think it's immediate or near term, but I think the other fear, as this thing grows larger, and it will be a bubble, that when the bubble bursts, the safeguards won't be in place to have a normal retrenchment. So I guess the best description is now party on, dude, for the next hours, days, weeks, and several months, but prepare for the worst of the worst for the next 1 to 3 years.
Yeah, and you can do that best probably by physical metals and with some exposure to the miners, right?
Yeah, the great news for all of this is, I mean, you and I and a very, very small minority through thick and thin stayed very, very bullish on gold. And I want to emphasize this. This is not a pat on the back for you and me, but to understand how much the wringing out of any speculation in gold took place during this correction from last September till now. If we would just go back and if we replayed some of our interviews from a couple of months ago, we talked at that time on how many people have abandoned the bullish camp, or at least pulled back greatly and greatly lowered their expectations. We were hovering in the 1525, 1550 area. There was just constant, almost hourly commentaries out how gold is topped out. All these so-called guys have supposedly sold it. The perma bears who were wounded time after time after time dusted themselves off one more time, wiped off the blood, and again stood up and said, the end is here, only to see gold build the base you and I spoke about, break up above key support, and now, with all the other bullish factors that already existed, now has not only the creation of money, which is dilutive to paper money, but its main nemesis, if you want to call it, which I think has been a debasing nemesis, the U.S. dollar, is going to go lower. And so for those of us who have been bullish or even turned bullish today, the thought of higher prices are much easier for me to look at than it was just a week ago. The 2000 number, which that I've always felt and was willing to bet a couple million on it, was always a question of when, not if, I think will be ratcheted up soon. I think we are going to see the break of the old highs and a break above the 2000 perhaps sooner than we thought. And that's not taking into account some of the geopolitical concerns that maybe not everybody is starting to price into gold, but some people are, whether it's the military in the Mideast, a potential conflict with China and Japan, which would be used, and just general geopolitics of what's happening throughout the Middle East and Islam versus Christianity and all these things. So it's all systems go in the gold market, and it's still amazing that 99.9% of American investors, because that's who I intertwine with every day. I'm not in Canada every day. I'm not in Europe, but I speak to and almost involved both in this business and my other business with American investors, and I can't find 99.9 who've purchased gold or owned gold in the last 1 week, 1 month, or 1 year. So it's not only been the greatest stealth bull market, but there's still so many more people to still come into this market before we can even begin to think about it being saturated and fully invested.
Yeah, great point. No public participation. And just to add emphasis to the point you were making about all the perma bears, we were at Hard Assets New York, which is a mining company exposition for the most part. And when you see Dennis Gartman have a larger audience than Eric Sprott, something is really wrong with the world.
Well, I want to say this and hope you don't mind. Of all the what seems to be anti-gold people, at least at times, even if it's for a short period of time, and even though we have to go through his mocking and his abrasiveness and his arrogance at times, Dennis Gottman has at least at times not only recognized some of the positive things for gold, but actually has been positive towards it. And in fairness to him, he's never made to anybody that he's anything more than a trader. However, others, and let's leave them nameless for a change, who have been just permanent bears, one in particular who just days before the announcement went on Canadian financial news and stated to the world that him and his group don't see any chance of the Fed doing what it ended up doing and how gold was going to come down hard. And there's never a renouncement by them, and well, even when they get questioned, no one goes, hey, look, before I ask you where I think gold's going forward, what do you have to say about your call before when this didn't happen? It's as if it never existed. So they just kind of forget what they've said for years, and they get to their latest bearish position. So the gold market still has an awful lot of room for new money and new people to come in, and all the systems of gold have just been fueled with fire by the move that the Fed has made.
Yeah, I know exactly who you're talking about. We'll keep him nameless, but the point is...
somebody said to me, I just want to take care, and I do appreciate, and that's why I take the time to speak at your show, because you're very honorable, and you allow me to say things that maybe some others don't. But somebody pointed out to me, and they're right, although I don't think I'll be honored to honor their quest all the time, and this is say, when you bring up their name, you're giving them recognition that they really don't even deserve to have their name said. The problem with that, and as I said to this gentleman who brought that to my attention, is there's a whole lot of people out there who don't know yet that about the person, and it's almost like a feeling you want to warn them, about listening to them. And I want to make this point, and I made this point in an interview yesterday as well. It's not a matter that they've been wrong. Not only have I been wrong at times.
Yeah, we all
have. One of my best guys that I ever respected in this business has been wrong for years on gold, and that's Bob Prechter. But unlike the other unnamed people, Bob has been a gentleman. He's been never arrogant. He doesn't make fun of the people that oppose his views. These are all the things these other guys do and belittle them. And then when he's been wrong, he notes it in his commentary and says, yes, I have been wrong for years, but this is why I think it is. When these people don't even mention the fact that they've been wrong, and their arrogance gets in their way. So thank you for that. I just want to make sure, because I know people listen to this, and it's an important thing to know.
It is. And I don't have any problem naming names. I think that you go back and you look at what people have said, and it's easy to do on the internet. And like you said, this one person whose initials are JC, but we won't say anything else, was predicting no QE3, gold is going down, up until seconds before Helicopter or Escalator Ben got on the cameras and said, oh, we're doing QE3. And even then, I still don't think he believed it. Or if you want to be cynical, the guy is just craven and knew it was going to happen all along, but he's such a gold bear that he just couldn't let it go. But
well, I think the part of that, which is why some spanking is deserving, even with the follow-up question from the journalist, but if you're wrong and they do that, he still said, well, even if we are wrong, gold's still going to go down and not benefit from it. So he was like ultimately wrong twice kind of things. Look, the bottom line is this. Call those of us who've talked about manipulation and suppression and all that, kooks, tinfoil hat wearers, all this other stuff, the gathers of the world. They've been right. The perma bears have been wrong for a decade. Not one call, not 5 calls, not 1 year, but for 10 plus years.
And counting. And they continue to be wrong, and they won't admit they're wrong. They're just like the mainstream media in that respect, where as long as nobody goes and researches and does a Google search, they seem to appear to know what they're talking about. Or just like the people that got us into this financial disaster in the first place, the Federal Reserve and those certain members of the elite financial institutions, which said, don't worry about a thing. Everything's going to be fine. You know, the housing will continue to go up. Buy a house. It's a great investment. And now we are where we are. And these people should have been discredited, and they should be banished from the analyst community. And yet they're still on top. So forget about justice. Forget about truth. Forget about the American way. Buy gold, buy silver, and just sit back, because that's probably your best strategy for the move ahead. So, Peter, hey, thanks so much for being on. If you want to hear this interview as well as many of Peter's correct calls, financialsurvivalnetwork.com. You find Peter, sign up for his free newsletter on Grandich.com. We'll talk to you again soon, Peter.
Thank you, Gary.
Be well.
All right, take care.